Welcome to Focus on Alternatives, an educational series from ADISA, the Alternative and Direct Investment Securities Association. At ADISA, we're committed to providing insights and thought leadership on alternative investments. My name is Greg Mausz. I'm your host for today's episode. I'm pleased to be joined by Keegan De Silva. He's the CEO of Quincy Wells. Keegan, great to have you here. You've been working in the financial services and actually due diligence for over a decade. Today's topic is all about evergreen funds versus lifecycle funds, kind of pros, cons, and I want to start by defining what each of those are.
Yeah, 100%. First of all, thank you so much for having me. Looking forward to this discussion. Let's start with the lifecycle funds. I think for traditional independent broker-dealers, this is where diligence officers have been trained more classically in evaluating risk. And the reality is it's because it is a finite term with finite fees and a clear investment mandate that you can judge performance at the end of the hold. With the evergreen vehicle, I think it's through the advent of the RIA structure becoming obviously more predominant in raising capital, we've created a structure to be able to appease the liquidity needed to have something that can scale with an RIA. And that makes it a lot more difficult to think about how funds being used. A lot of money that is going into the evergreen vehicle can be used for redemptions, can be used for improvements on assets and other things. And so it's very difficult on the front end to know what is actually going to happen through the life of the fund. And so the risk profile is a lot more difficult to evaluate risk. And I think at a lot of independent broker-dealers, you're going to struggle with having people who have a lot of experience in evaluating that structure. But the difference in structure, again, with the life cycle, again, it's a finite term. With the evergreen vehicle, it's evergreen, it's perpetual. And because of that, there's unknowns that exist in the evergreen structure. Why the evergreen has appeal is it has liquidity provisions in it. And so that allows investors to think about taking chips off the table throughout the whole period and allows you to have a net asset value that's reported to you on a consistent basis to see how your investment is performing.
So breaking that down further, you really have a different type of risk, right? So on the evergreen fund, to your point, it's a little bit more blind pool because you don't know how that's going to go. But if the fund continues to grow, it may be a significantly larger, more diversified portfolio versus your life cycle, which may be potentially a smaller fund, right?
Yeah, 100%, right? And I think, again, this goes back into the salesmanship or, again, the diligence aspect of it. I think whenever you can diligence a defined thing, you can outline the risks. Again, the upside may be capped because you're capped to a certain thing. Mm-hmm. Whereas in a evergreen vehicle, you're correct. You get to diversify over time. But obviously, you don't know what they're going to buy. And something we talked about off air is my concern with it is you tend to have to buy because you're raising money.
True.
And especially when things are trendy and things get more expensive and you're getting dollars, you're buying things at the wrong time. And so I do think that's a risk that people haven't necessarily understood from the beginning of the evergreen structure that we're starting to see in markets today.
Absolutely, because you're buying throughout the various cycles versus one point in time. So 100% agree. Is there a right structure for a client's portfolio, evergreen or life cycle, or can there be a blend of both?
I think, as with anything, there's availability to both, right? I think the reality here is I love being able to look at alts for generating some alpha and thinking about the entry point when I put money into something. That's my preference. But obviously, as you look at wanting an allocation to a certain asset class or segment to put into a client's portfolio, the evergreen vehicle allows you to always have access to multifamily or always have access to data centers or private credit. And so again, if you think of building a portfolio in an RIA, that's where perfect portfolio 1% should be allocated to X. I can find an evergreen fund that I trust the manager and I'll always have exposure to said thing. Whereas with, again, a life cycle fund, you're thinking about, I need to think about what is the thing when I get that money back, and is it a good point to go back into that thing, or do I go into something else?
Yeah, that ability to reallocate based upon current client needs and current market cycles on the life cycle funds is fantastic.
Yep.
You're right. Okay, so Do you think there's a structure that is more beneficial for a BD style financial advisor versus an RIA style financial advisor?
Definitely. Like the simple way I look at it is the Evergreen structure is going to be more appealing to the RIA. The Lifecycle is going to be more appealing to the broker-dealer. I think especially as we think about Reg BI and we think about the idea of the self-liquidating nature of a life cycle investment, you get that money back and then you're going to invest it into something else. And you could invest it into the same asset class at the end. Whereas I think if a broker took an evergreen vehicle, they put you in it for 2 years, and then they said, hey, this thing's doing great, let's sell all of it, and let's go buy something else in the same asset class. The question's going to be, are you doing that to get paid a commission again? And so I think it brings in that conflict that doesn't exist in the life cycle structure that exists in the evergreen structure. And then again, as I think about the idea of just wanting an allocation over a long period of time to a certain asset class or industry, the evergreen vehicle in an RIA. Additionally, you're thinking about the net asset value and being able to fee on an account. That doesn't exist in the life cycle structure, right? In the life cycle structure, you're just going to see one valuation for the entire hold, whereas on the evergreen, you're going to get periodic updates to that, so you know that you're charging the client something based on its current value.
Yeah, and that's actually very critical for RIAs, getting that billing right.
Yep.
So let's dig a little deeper here. You mentioned valuations, but can you unpack that more, the valuation methodology and procedures for a lot of the evergreen funds? And, again, how does that contrast and compare to the life cycle side?
For sure, right? I think on the broker-dealer side, you're selling someone something, the amount that they invest is what they're going to see as their investment throughout the whole period, no matter what happens. Whereas when you look at the evergreen, you're going to strike that NAV on a periodic basis, sometimes monthly, quarterly, and obviously more often the better. And it's based on giving the investor some understanding of, and again, each one is different, but what is the market telling you that thing is worth? And I think understanding the thing that you're investing in and understanding how it's reported is super important to the investor. And I think that's where the importance of the advisor and explaining how we get to a NAV and how we calculate a NAV is super, super important when diligencing any evergreen vehicles. So again, in the evergreen structure, you want to get that net asset value that tells you if you sold all of it, this is how much money you're going to get. That's how it functions. But again, in reality, it doesn't necessarily tell you that if they sold all of the assets that they currently own, plus all of the cash and other things that they may have in that structure, that's how much money they will get if they sold everything today. It's just telling you if they sold the amount that they have to sell, that's how much they think they'll get to you.
Right. Well said. The next thing I want to kind of drill down on is fees. With these different structures, there's also different sets of fees, different sets of potentially promotes or hurdles or incentive fees. Can you break down the difference there?
Yeah, I can break down the difference. And I think the most important fee that I want to talk about that is different between the two, that I think is really important for an investor to understand, is in an evergreen structure, the sponsor can benefit from participating in fees before the investor actually gets their cash. So you talk about getting a fee on an unrealized event, whereas in a life cycle structure, again, you're going to get paid before that sponsor gets paid what they're supposed to get paid based on the structure. So typically you're going to see a pref and you're going to see a hurdle, and the sponsor makes an amount of money based on the client getting cash. Mm-hmm. Whereas in an evergreen vehicle, your net asset value may grow, and because it grew, the sponsor is getting cash. They're getting to benefit from their net asset value growing, but the client obviously didn't get the cash as yet. And where you struggle with understanding the conflict that exists there is if you incorrectly calculate a NAV that gets above the hurdle that sponsor needs to hit, now they're getting paid, but the thing that you have isn't actually appreciated to the level that they disclosed. And so, again, it's really important to have good ongoing diligence on these evergreen structures because the sponsor is participating in fees during that and because of the NAV that's reported.
I've also seen incentive fees be income related, not just NAV growth related. Do you have a preference on which type of incentive fees work better?
Yeah, it's a good question. I think I would lean towards income-related incentive fees over growth-related incentive fees. And the reason is if you make that distribution, I should see it reflected in your NAV. So if you made that distribution and it was a hurtful thing to your NAV, then again, you're going to see that reflected in the NAV going to the client. So I do think there's a level of risk tying it to your income as opposed to the NAV, right? The NAV is a thing that everyone's going to be happy that they have a high NAV, so you're not going to get questions. Whereas if you make a distribution and then your NAV goes down, again, that's going to be a trigger event for clients wanting to understand, why did my NAV go down? So I would lean towards having incentive fees towards income over NAV growth.
Okay, thank you. Why does the financial advisor really matter when it comes to making a decision between Lifecycle versus Evergreen funds?
Yeah, for sure. I think on the Evergreen side, I can talk to, I think structurally, there's a huge issue with how they were built, in my opinion. And I think the advisor has to play a very important part in keeping discipline to the investor. I think naturally, you're going to invest in things, as we talked about earlier, that are trendy. And you're going to invest as things are going up, and you're going to pay more for it. And the concern comes that the only time that you're going to sell is when things are going poorly. And I think it's the advisor's job to make sure they think about providing liquidity and taking chips off the table throughout the whole period. I think that isn't fully understood at this point. I think people are going to start realizing, like, when things are going well, let's take some chips off the table and reallocate when needed. But I think the structure itself, unfortunately, and this may be a harsh take, is set up to buy things when they're high and sell things when they're low. And obviously we understand that you want to buy things when they're low and sell things when they're high. And so I think the advisor, knowing that the investor has the ability to get liquidity periodically, should be looking at those periods, not just when things are going wrong, but taking chips off the table when things are going right.
People do that with stocks that are growing. So, yeah, same philosophy. We just need to apply it to the Evergreen funds.
100%.
So when you look at Evergreen funds, I think of interval funds, tender funds, REITs, and BDCs.
Yep.
Does that pretty much encompass the main groups of them?
Yeah, I mean, for this conversation, I think, yes, thinking about those semi-liquid structures, I think those four hit the nail on the head for what we're discussing today. And again, I think like even the idea of this semi-liquid structure is a paradox, right? I think the idea here is like you are accepting that you're investing in something that won't give you the best return because you're paying for some level of liquidity. But then if you're not taking that liquidity correctly, you're paying for something that you're not actually getting the benefit of. Mm-hmm. And so again, it's like one of those things that I think if we understand how to manage the semi-liquidity, then it's worth paying the price for the semi-liquidity. But right now, we're not using that semi-liquidity correctly.
Keegan, thank you for walking us through these various parts. Do you have any final thoughts in this debate between Evergreen funds and Lifecycle funds?
Yeah, I think, again, the debate is at this point in time, right? And I think at this point in time, the understanding that the public has about life cycle structures is a lot more defined and disciplined than they have about the Evergreen vehicle. I think the Evergreen vehicle has gotten so much adoption so quickly, and the amount of money that's being raised is so great that if people don't take some time to understand how we should be using it correctly, it creates additional problems outside of just the diligence of the thesis. It's also the diligence of, like, does our sales force, meaning the financial advisor, know how to advise the clients to use the structure correctly? And so there's a level of understanding at the various wirehouses and broker-dealers and RIAs that if you don't have advisors that understand how to use the product, what we're diligencing doesn't really matter because it's not going to be used in the way that it was intended to be used. So that's why I don't want to be too harsh on the structure. It's the use of the structure. I think whereas the life cycle vehicle for me is I did diligence on a sponsor. I believe that they're the best person to grow my money. I'm going to give them the money and then say, I trust you because I did diligence on you. And I don't want to be the person telling you, or a passenger princess, and telling you what to do with the money. You are the person that I trusted with the money. You tell me when you think it's best to sell. Whereas I think there's too much power given to investors in the Evergreen vehicle as it's currently used. I'm not saying as it's currently structured, but as it's currently used.
Right. And to kind of counter that, on the life cycle side, you just don't make one investment. You make multiples with different sponsors and different asset classes, potentially in different geographies, so that you're making lots of small bets. And because you can't always see what's going to happen in 5 to 10 years during that life cycle, but chances are, if you're diversified, the majority of them are going to work out, right?
100% right. And I think that's the other side of it is like you should never be evaluating, I'm putting all my money into this evergreen or all this money into this life cycle. The reality is if the evergreen vehicle is something, as you said, is going to diversify over time, use the life cycle in the same way. Put less money into each one, and then all of a sudden you have your own fund of life cycle investments that will give you the same level of diversification. And again, the only difference would be that, again, they self-liquidate instead of in the evergreen where you just take liquidity when you need to.
Wonderful. Keegan, thank you so much for joining us.
Perfect. Thank you so much again. This was great. Look forward to another conversation in the future.
And for more resources and information about alternative investments, please visit ADISA.org. Stay tuned for our next episode coming soon, and don't forget to like, share, and subscribe to the ADISA YouTube channel.